The old rule used to be any 2%, the moment you get to the point where 2% up and down days are extremely prevalent, the VIX goes over 20. It used to be the definition of panic. We seem to be testing that theory with VIX spikes to 40 to 60 in the post-pandemic world. But nonetheless, when you get to a point where, as we saw this week, you get an extraordinary rally in stocks, you're usually in the midst of a major correction. As a matter of fact, we had the eighth strongest bump in US equity market history midweek this week. All 15 of those other big bumps in US equity market history occurred in the midst of 30% or greater declines in stocks. So it's pretty clear just based upon the degree of the rally that we had this week amidst the weakness that we had had the week prior and earlier in the week is evidence that we are entering panic mode. We are fully in the crux of some sort of market disruption, market crisis that is pretty severe.
What does that mean for the upcoming earnings season? Are investors just not really going to pay any attention to earnings and it's all going to be macro-led this coming quarter?
I actually think that earnings will become incredibly important because we have at least a sense of how bad the tariff environment can get. We seem to be settling around a likelihood that we end up at greater than 20% average tariff rates in the United States. Now the question is, what does that mean for earnings? Analysts have done very little to actually reprice the earnings outlook or reestablish the earnings outlook for companies because they were, of course, waiting for clarity on what is going to happen with tariffs. So everything that's been put in the marketplace right so far has been about scenarios. Now we get to the point where we can presumably start to figure out what the actual numerical impact of tariffs are, and that will start to emerge with earnings results. I don't know how much companies are going to be able to offer a tremendous amount of clarity on that, and that's going to create probably further disruption in price trends. But now we will start to price tariffs. In my view, we've been very volatile over the last week because the market is trying to price tariffs without a tremendous amount of intelligence from companies and analysts with respect to what those tariffs will ultimately mean. Now we're going to get that intelligence emerging.
Well, who faces the more immediate cost with the hit because of tariff turmoil? Or do you just take the easy path and withdraw your guidance?
Yeah, I think that companies will probably be forced to withdraw guidance because they don't have a tremendous amount of clarity. I think they're going to negotiate, right? Just like the president is suggesting that he's going to negotiate with countries, companies actually pay the tariffs when the product goes across a border. So companies are going to have to negotiate with their suppliers. They are also going to have to test the consumer market for how much tolerance the consumer has for price pass through. And that's going to take a matter of months before companies can come to any resolution as to where things are likely headed. I think there is still a little bit of uncertainty as to where tariff levels are headed as well, though we got a lot more clarity with that over the last month. And so they are going to have to remain somewhat nimble. But in my view, we're just getting to the point of really testing and implementing some of these elevated costs, and that creates a lot of disruption in the outlook for fundamentals. And it's quite clear that companies are going to struggle to provide a tremendous amount of guidance for what this means for 2, 3, 4 quarters from now. Instead, they may focus much more near term on how they're implementing change, how they anticipate to negotiate cost increases, and how they see the consumer or their ultimate buyer eventually responding.
Gina, we're down 10.5% year to date on the S&P 500, at least in this very second. What are the signs that BI looks for that a bottom is actually forming? Have we seen any of those signs yet?
Yeah, so in theory, we saw some of the signs already that at least the early stages of a bottom may be forming, but the degree to which we can see further weakness emerge is still very questionable. And what I mean by that is historically, you see these major capitulation events as at least the beginnings of a bottom. We definitely saw a capitulation event over the course of the last week with the VIX spiking as much as it did, with correlations rising across the world. Although I'll say there's more evidence of capitulation in global stocks than there is in the US. And there are a lot of mixed signals coming from the bond market as well as currencies with respect to a normal sort of economic disruption. So we're still working through a good deal of that in the marketplace. This is a historic event by any stretch of the imagination. We have not been in a climate in which tariffs have accelerated this much, this fast ever in developed market, equity market history. And so the result of that is tremendous uncertainty, which probably persists for an extended period of time. But at least from a normal standpoint or a historic standpoint within the equity markets, the degree to which we saw VIX and pairwise correlations rise would be evidence that we at least have potentially started a bottoming process.
Bloomberg